Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talk about? Well, I want to jump right into Mind to Trade again this week, and I think it's important to talk about staying disciplined, doing less than ideal conditions, specifically patience, and that'll make a lot of sense in a few minutes. What's interesting is we have a buy signal imminent in the Qs, and that led me to do a little research on that. And the system, as you probably know, was originally designed for the S&P 500, and we likely won't see a signal there for quite some time. But I thought it was pretty amazing that the Qs are on the cusp of setting up, and we'll take a look at that in just 1 second. Plus, I want to flesh that system out quite a bit. Housekeeping, I do take requests, as I say each week. It makes my job a lot easier. Send them to davelandry.com/contact. If I can't fit them into this slot, which is somewhat limited as far as time is concerned, I can cover it in my weekly show, which is Dave Landry's The Week in Charts, and that's every Thursday night at 6 Central. Go to davelandry.com/webinar to register. If you need to reach me on Twitter, at TFollowingMoron is my handle, and at Dave Landry on YouTube is my YouTube channel. If you want the slides from this presentation and all the other presentations combined, go to davelandry.com/StockCharts. And I'll also throw in all three of my books in PDF format. So for Mind to Trade, this week I thought it'd be important to talk about patience given the less than ideal conditions. Now, I showed these slides last week, and I think I might keep showing them for a while, and I updated the charts obviously. But if you start looking back, in other words, the net price change, and as I often say, it's the Rip Van Winkle sleep test. Pretend you go to sleep and you wake up a month later or 2 months later or 3 months later, in this case, almost a year later, and you looked at the newspaper before you went to bed, and then you wake up and look at the newspaper again, and you think, oh, you know what? The market didn't do anything. And that's the importance of looking at the net price change. Now, if you follow the bouncing ball, you could see the market was all over the place. Now, net basis, again, nearly zero gains. But if you look at the highs and the lows and connect the dots, it's kind of all over the place. Now, like I said last week, it has a look of an electrocardiogram to it. It's just kind of erratic and all over the place. Now, Leo Tolstoy, who, to my knowledge, was not a trader, but he once said the two most powerful warriors are patience and time. And I'm having to remind myself of these things too, and this is probably why we're talking about it today. I woke up and wrote about it over the last couple of days. And as I showed a couple of weeks ago, by accident, I found an old portfolio. Current portfolio is actually underwater. It only has one stock in an MBLY, which we talked about in prior weeks. But I found an old portfolio based on the model, and it had $53,000 in open profits. And the model is based on a 100K model. So that reminded me, and it's like every now and then, you get the reminders of things that you need. What's the old saying? Experience is what you get right after you need it the most. Kind of like one of those things. But it reminded me to stop trying to force things to happen so much. Now, in my trading service, I'm pretty good about not trying to force things to happen. I haven't had a setup since March 6th. And then I did find another presentation, for what it's worth, where we went 52 days from setup trigger to setup trigger. So there was 52 days, and that's what is that? That's like 6 weeks without anything triggering, 6 weeks of sitting on our hands. There might have been some setups in between, but none of them triggered due to the conditions. And on many days, like lately, like I just said, since the 6th of March, I haven't recommended any new stocks. Now, I'm not a huge fan of GAN, and the main reason is because a lot of this stuff is very esoteric and arcane, and I've known people who have tried to implement it, and they failed miserably. Not to say that his stuff doesn't have any merit. It's just not for me. And Gann himself, according to reports from his family members, wasn't very successful with it either. But I would never be schadenfreude, especially right now while I'm going through a drawdown. But I don't think that he had this magical formula that everyone believes. What I do believe is that Gann knew a lot about the markets when he wasn't trying to do the square of 9 or whatever else that stuff is and draw 10,000 lines on the chart. some of the stuff he said made a lot of sense. And he had a lot of common sense. In fact, I'd recommend you read, I call it the Orange Book. And the name of the book is How to Make Profits in Commodities. I'd recommend you get that book just for the first maybe 30 or 40 pages, because in it he talks a lot about, it's almost like kind of Jesse Livermore in the way he talks about the markets. And it makes a lot of sense. And then the rest of the book, not so much. But one of the things that I picked up on this morning is, remember, on a reread, remember, you often make money by staying out of the market and waiting for an opportunity. And Livermore said something very similar. In Reminiscences of Stock Operator, he said, in fact, I always made money when I was sure I was right before I began. What beat me was not having the brains enough to stick to my own game. That is, to play the market only when I was satisfied that precedents follow my play. There's a time for all things, but I didn't know it. And that is precisely what beats so many men in Wall Street who are very far from being in the main sucker class. There is the plain fool who does the wrong thing at all times everywhere, but there is the Wall Street fool who thinks that he must trade all the time. No man can always have adequate reasons for buying or selling stocks daily, or sufficient knowledge to make an intelligent play. In fact, I always made money when I was sure I was right before I began. What beat me was not having brains enough to stick to my own game. That is, to play the market only when I was satisfied that precedents favored my play. There is a time for all things, but I didn't know it, and that is precisely what beats so many men in Wall Street who are very far from being in the main sucker class. There is a plain fool who does the wrong thing at all times, everywhere, but there is the Wall Street fool who thinks he must trade all the time. No man can always have adequate reasons for buying or selling stocks daily, or sufficient knowledge to make his play an intelligent play. Boy, am I guilty of a lot of that behavior. And one thing I've done lately, and whenever I fall into this trap, I realize that I'm getting in trouble, is I'll actually look at something like change from open to see what stocks are moving, to see if there's just something out there, because there's got to be something, right, that I could just jump on. And usually when I get into that type of behavior, I get into a lot of trouble. Now, Livermore went on to say there was the huge quotation board staring me in the face and the ticker going on and people trading and watching their tickets turn into cash or into waste paper. I got this term from Dave Keller, and he got it from Todd Harrison, flickering ticks. So that's him talking about the flickering ticks, even though this might have been a chalkboard and some sort of ticker tape. Of course, I let the craving for excitement get the better of my judgment. The desire for constant action, irrespective of underlying conditions, is responsible for many losses in Wall Street, even among the professionals who feel like they must take home some money every day as though they were working for regular wages. Now, I've been searching for about 2 weeks to try to find this quote, and I can't seem to find it. I don't know if it's classic Gann or Schaubacher or Livermore. I really thought it was Livermore, but I can't seem to find it. Maybe Douglas too, something that's a little bit more of a modern classic. But I'll eventually find it. And if you know who said something along these lines, please let me know in the comments below if you're watching this on YouTube. But paraphrasing this quote that's in my head, those who feel that they must trade day in and day out, and I'm inferring in less than ideal conditions, are laying the groundwork for your next venture. Now, this is something I've been working on, and it could be a presentation, I think, in and of itself when it comes to markets. People may buy or sell for a variety of reasons, as I've discussed before. It might be fundamentals, they might have money, they might need money, they might have some sort of complex formulas they're using, maybe they're using some of Mr. Gann's esoteric stuff. But the bottom line is, when they do make their trades, they're either a bull or a bear, and it doesn't matter how they come to their conclusions. And there's a whole psychology and neurology about the fact that when they actually make a decision, they're making an emotional one. But that's fodder for another presentation. But obviously, a bull is in a good mood, at least when it comes to the market, and a bear is in a bad mood when it comes to the market. And that's kind of all you need to know. Is the market going up, or is the market going down? Is the market in a good mood, or is the market in a bad mood? Now, what's interesting is when these two come together and begin to fight it out, it becomes choppy. The bulls sort of cancel out the bears and vice versa. Now, if you think about it, as the bulls and bears are fighting it out, the market gets into a trading range. And it might take a while, and it looks like it's taken a year so far, but it might take a while, but eventually that range will begin to narrow and form a base. Now, what happens next is we'll have some sort of base breakout, either higher or lower. So the bulls will win eventually, or the bears will win eventually. Now, it doesn't matter as traders which way the market goes, as trend traders that is, as long as it trends in one way or the other. I would much rather a bull market, but if I'm stuck in a bear market, then so be it. But bear markets are much more difficult to trade. And right now we're in a choppy market, still in a bear market, but we're in that choppy phase of that bear market. Now, patience requires discipline, and discipline gets used up. Now, if you're like me, you probably have thought at various times throughout your adult life, hey, I'm going to work out today after work. And you're all gung-ho, like, yeah, I'm going to go to the gym. It'll be a great way to get rid of the stress of the day. But what usually happens is the stress of the day comes, and they, be whoever they is, coworkers or the markets or whatever, sort of wear you down. It's very hard to go to the gym after work. I've tried it on and off forever, and the only way I can ever go to the gym now is every morning, I guess around 7:30 or so. As soon as I get the market a minute done, I go straight to the gym. It's part of my routine. I try not to think about it because if I do, I won't go. But I use that early morning discipline while I still have some to go to the gym. And I would recommend, if you're going to exercise, to do the same thing. Now, I see guys, these old guys dressed in their little fancy lad suits, riding their bikes every night after work. You know, God bless them. But I don't have that type of discipline. I'm usually wiped out by the end of the day. Nothing wrong with being a fancy lad, by the way. It's just those tight little outfits. I don't really see the need for them. You know, especially some of these guys, biscuit shy of 300. I'm like, I'm not sure it's going to help your mileage very much. But I'll probably get some hate mail from some cyclists. And I do cycle, but I just don't put on those fancy lad clothes. Other than the shorts. I like the shorts because I got a small butt. Anyway, I digress. Choppy markets are the worst drains on discipline. They will wear you down, and it's been wearing me down a lot lately. Now, the longer you wait, the more you will be susceptible to boredom or impatience, needing money, wishes or wants, and a plethora of other things that have nothing to do with the market. Now, here's another one, and I always say I'm going to do a presentation and not mention it, but today's not that day. Intuition versus intuition. I read that in Market Wizards, and that's from Ed Sakota. And basically, that's, you feel like something is going to happen, but you're just trying to make something happen as opposed to seeing what is. And getting back to the boredom and impatience and people craving action, as I've said 1,000 times before, many, many years ago, I was part of the first website ever for traders. I think it was us and Market Wizards. And I had a trading service, and we actually had salesmen back then. And the salesman would call me during times like this, and they'd say, Dave, please recommend something. We're losing clients. And what was interesting is, and I wasn't going to recommend anything if I wasn't going to do anything myself. Just I wasn't going to recommend things so people could have action. If my modus operandi was to sit on my hands, then I think that's what they should be doing too. But anyway, long story in this, the salesman would beg me to recommend stocks, because if I recommended stinkers, we would lose clients, but we wouldn't lose that many. But if I recommended not doing anything, we would lose a lot of clients. And that just showed me very early on in my career that people crave action. Now, again, you're going to need a lot of patience during choppy conditions. And you need to keep doing your homework. Or, of course, feel free to pay me to do it for you, because I'm here anyway, and I'm doing that homework. I'm doing those scans every night. I'm going through a couple thousand stocks. And the reason you have to do that is you never know when the next big winners will come along. And I don't want to talk about any specific stocks because it would rub some salt in some of my clients' or ex-clients' wounds. But I've had quite a few times throughout history where people have quit and said, Dave, I appreciate what you do. I like what you do. But I don't see any setups for a while. So I'm just going to take a break for a while. And I'm going to quit trading. And I'll check back in later when conditions improve. And a lot of times, not all the times, but a lot of times it's like the same day I'll find one or two setups, and one of those two, or maybe even both of them, will become the biggest winners of a year. Now that doesn't happen every time, obviously, but it happens often enough to keep me in the game. Now you have to, of course, resist the time pressures and extraneous influences. And believe me, I'm put under a lot of time pressure because I'm not only trading for me, but I'm providing analysis for my clients. And I know they're getting sick of me saying, hey guys, let's just continue to sit on our hands. One thing you have to do in getting back to the intuition is you have to see the market objectively. And you can't say, well, it's been choppy for so long, it's due to trend, so let me just jump in and try to catch a trend. The other thing too is you have to be really careful about selective perception. You might see some stock take off without you, but for everyone that takes off without you, there's probably 100 that didn't. And this is kind of talking out of both sides of my mouth when it comes to the continue to do your homework, and that big setup comes along every now and then. Just make sure when you think you have something that you really, really have a fantastic looking setup. And the other thing too, just real quick, is that ideally you want the market and the sector and the stock all going in your favor. In other words, you want the stock to be set up and looking fantastic. You want the market to be trending, and then you want the sector to be trending. And it's very difficult in a market like this to have all three of those things working. But if you really, 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 really like the setup, like those aforementioned setups that take off, okay, then by all means take it. Just make sure you're, again, I hate to beat the dead horse in this, but make sure it's intuition and not intuition. Now, again, I can't beat the dead horse on this enough. You really have to pay attention to the net price movement. Listen to the database. That's another one. That's a big one for me. As I think I mentioned earlier, I look at a couple thousand stocks every night. And if I can't find a setup to save my life, then I know I shouldn't trade. If I have a plethora of longs that all look fantastic and I can't decide between them, and it's taken me an extra 30 minutes to figure out which ones I like the best, then I know I need to trade. But if I can't find something, again, to save my life, then I know not to trade. And again, as I think I alluded to a second ago, be careful of selective perception. A market might take off without you, or a stock might take off without you, but just make sure that you actually missed the setup that was there. Sometimes markets just move, and your methodology might not catch that move. So again, during times like these, it takes a lot of patience. Patience requires discipline, and discipline gets used up. So work hard to make sure you're seeing what is. And again, I think the net price change could be your best friend there. Your own trading, obviously, if you can't catch a trend to save your life, the market probably isn't trending. All right, let's shift gears and talk about overall market timing. Now, the TFM 10% system, and these indicators are free in the ACP module. Just like this video, and you should get them for free. And you go to the ACP and then load them up. They'll be down here on the little plugin. Just click that, and you should have access. Now, this is 90% of the closing high, and this is used for S&P timing, for the cash S&P. Now, what I did, just to show you what high that's coming off of, is I put in 100% of the 50-week closing high. And you can see the parameters are right here. Weekly chart, 90% of the 50-week and 100% of the 50-week. So back here, it was going off of this closing high right there, which was set in late 2022. And when the market drops below the 50-week moving average and the buy line, or the 90% of closing high line, that is a sell signal. So this was the first sell of the year way back in January. Now, I didn't intend this to be a feature, and it just sort of happened this way. I didn't realize how it would work out. But in a spike recovery, like a spike bear market, as if the market drops really hard and then comes right back, this line is not going to catch up with price. But over time, eventually it will. So if we get a longer term bottoming type of market like 2009, and like hopefully, I know I just said hope, but hopefully what we're seeing lately, where the market's kind of trading back and forth but not making those new lows, the line will begin to catch up with prices. So if we look at the 100% line of the 50-week closing high, you can see we've dropped all the way down to this closing high. So over the next several weeks, we'll probably drop a little bit more. Now, notice that if we zoom in, for the buy signal, you need a close above the buy line, and you need 2 bars of Landry light. Now, Landry light is just lows greater than the moving average. In this case, it's a 50-week moving average. And you can plot the Landry light indicators on your charts. So that would be 1 week of Landry light because the low is greater than the moving average. And then provided that we hold this week, this will be the second week where the low is greater than the moving average. So we could actually see a buy signal. Now, one thing I didn't think about when I designed this is, as a trend follower, systems should buy on strength and not weakness. But you can see the market has come in a little bit as I'm recording this. I don't know if you hear the dings that were going off in the background, but those were alerts to tell me that the market was hitting new lows, and I had to go in and take some action based on that. So even if this is a buy signal this week, I would not get too excited about it unless the market started going up. So what you might want to do is say, okay, well, it's going to have to close above this high, or at least close at a higher close week over week before getting long. More importantly, and the designer's intent was with this, as I'll show you in 1 second, was to get you out of the market during adverse conditions. But if you are looking at it on a mechanical basis, yes, we could see a signal here in the Qs on Friday, which is just a couple days away. Now, getting back to my designer's intent was to get you out of trouble when the market took a bit of a spill, the so-called diaper change moment. You want to avoid those, and that's from Ian McActivey. And as you can see, if you exited right around that level there, you would have lost about 10% from the closing high to where it triggered. And you would have made a little money coming into the trade, obviously, but you'd have lost around 10% as opposed to losing another 75% of your money as the market continued to drop. Now, using the 10% system in the Qs, due to higher volatility, maybe a little bit wider percent of close could be considered to help reduce some of the whipsaw. I haven't tested all that just yet. Again, the system was originally intended for the S&P 500, but that's just some food for thought. Now, remember that market timing works best when there's an occasional bear market. If you go back to, let's say, the pandemic, and in fact, during the pandemic, you had that spike recovery. Now, the system would have gotten you out of the S&P 500 and saved you about 30% of your money, but that money did come back. Now, remember, that'll work until it don't when it comes to trading, or a buy and hold, I should say. But remember that market timing works best when there's an occasional bear market. That 75% drop I just showed you after the exit would have been avoided. And that's the whole idea with this. Let's say you save your whole life for retirement, and then the market has a 50% or more spill. You've just lost half of your retirement. Now, as I alluded to a minute ago, the system can trigger a buy on weakness, and that was not my original intent, but I'm not going to go in and change the system because I made this live about 5 years ago. I want to just continue to walk forward with this and see how it works. Now, the bottom line with this is I think some market timing is better than none. The old hedge fund adage comes to mind: he who fights and runs away lives to fight another day. One thing I was thinking about as I was going live, and I was doing a little research based on some of the stuff that Greg Morris has done, the buy and hope people, there's a lot of trickery and a lot of things they say. They say things like, well, if you miss the best days, your performance really goes down. But the thing is, what if you miss the worst days? And the bottom line is, as I often preach, talking about where bad things happen, once momentum begins to wane, or once the market begins to drop, you tend to have your worst days. So you will tend to miss your worst days, and you certainly will miss a 75% drawdown if you're out of the market as a bear market unfolds. Well, that's all my time this week. Again, if you want the slides from this presentation and a bunch of stuff to keep you busy for a long time, go to davelandry.com/StockCharts. If you need to reach me, davelandry.com/contact. If you want to join me on Thursdays, would love to have you. Bring your favorite stock picks, bring your questions, davelandry.com/webinar, and Twitter at tfollowingmoron. So again, I want to thank you guys for watching, and may the trend be with you.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.